Peter Lynch, the hottest investment tips for the 21st century. Sometimes you're out of ideas and just need some fresh ones. And in that case, go look at a Peter Lynch speech. Peter Lynch is considered one of the best fund managers in the world. He was the one who beat the market year after year back in the 80s and 90s with the Fidelity Magellan Fund. And his goal was for all the small investors to be able to buy into great businesses on sale, so to speak. He knew how to identify what made a great business for investment. He knew like no one else about companies like Walgreens, who, if you had invested $10,000 back then, would now be worth $2 million. He knew some great businesses with fantastic futures ahead of them, wherein they could be bought at low prices because they were poorly managed or not very well understood. Number 1. Take occasional setbacks to win the long run. Success in the stock market requires a willingness to tolerate occasional failures and unexpected events. They aren't scared off by a few bad dips, in other words, Peter Lynch. As a long-term investor, Lynch agrees with most successful investors that patience is the key to success. For long-term investment success, he says you should stay away from the two emotional states of concern and submission. Concern is the first state to emerge after a significant market correction. Taking advantage of this correction is a wonderful opportunity right now. When it comes to making smart investments at low prices, your worries operate as a barrier. Capitulation occurs when your investments are affected by a market correction, at least until the next large downturn when they swiftly become short-term investors and sell for huge losses. Many investors think of themselves as long-term investors, says Lynch. Number 2. Track what you own and why you have it. A wise man once said, "Never risk your money on a concept you can't draw." In other words, Peter Lynch. Investing nowadays is full of hot topics, whether trading in futures or options, betting on a hot stock, or purchasing a cryptocurrency that claims to send you to the moon. As a result, many people fall prey to this advice. As a result, Peter Lynch's counsel, "Know what you own," is more vital than ever before. There is no point in owning something that you cannot explain in 30 seconds or less, Lynch opined. There's nothing unique about this. Investing in any financial instrument, whether it's stocks, annuities, insurance, or a mutual fund, should only be done after you thoroughly understand how it works and the associated dangers. Even if you don't become a multimillionaire overnight, you may rest assured that you'll have a good night's sleep after investing wisely. Know why you own it, the second portion of the instruction, is equally crucial. You are more likely to avoid impulsive investment mistakes if you link your solid investments to your long-term financial goals. This is because you know that if you stop making investments, you will never accomplish your goals. You'll be a better investor if you adopt a disciplined mindset, which will help you cope with market volatility. Number 3. It's time to let your winners go free. Let your winners run and cut your losers. If you're not careful, you could easily end up destroying your garden instead of enhancing it. In other words, Peter Lynch. Throughout his career, Lynch held a variety of stocks. In some cases, his investments performed poorly, but in others, they performed admirably. Keeping his best performers instead of trying to cash in on short-term rallies was key to his long-term success. His phrase, 10-bagger, describes a stock that has increased in value by 10 or 100,000%. His rule was to wait for the fundamentals to change before selling to locate a 10-bagger. Even if these equities soared by 40% or even 100%, he wouldn't let them go. If you are outstanding in this profession, you are right 6 times out of 10, says Lynch. It's important to remember that your success should outweigh your failures. In this case, patience is the key. Even though many investors are still far from their financial goals, they feel compelled to cash in on their mutual fund gains, following a year of strong performance. As a result, individuals miss out on the opportunity to benefit from compound interest and hence miss out on the opportunity to accumulate wealth. Profit booking is a valid strategy to rebalance your portfolio according to your asset allocation. For example, your portfolio may consist of 70% stock and 30% debt. The stock portion of your portfolio has risen to 80% following the recent advance in the equities market. Your portfolio will not be skewed if you take profits from equities and reinvest them in debt, so as long as you do not exceed your risk tolerance. Number 4. You can't kiss every girl you see. Do not feel pressured into kissing each and every girl in the room. I've missed a few 10-baggers, but it hasn't stopped me from beating the market. Peter Lynch, author. Lynch writes in his book, One Up on Wall Street, that it was not a realistic objective for him to kiss all the gorgeous girls in high school and college. The same holds true for investment. It's impossible to acquire all the best performing stocks or mutual funds. My career has been full of beautiful, standard kisses, even though I missed a few supermodels. I would have liked to invest it in more multi-folding stocks, but this has not harmed my long-term results. It's a common mistake for investors to select funds based on their success in the previous years. Their mutual fund holdings constantly shift as the list of top-performing funds grow. As a result, they end up with a disorganized portfolio that hinders their efforts to accumulate wealth. This is why it is better to adhere to a strategy of discovering and investing in solid, steady funds rather than chasing after any pretty or top-performing fund on a short-term basis. Simply adhering to these guidelines can yield beautiful, long-lasting results. Number 5. Make your entrance, but not too soon. Investing in growing firms is like baseball to me. You're taking an extra risk if you buy before the lineup is announced. In other words, Peter Lynch. When it comes to making investments, Lynch says you shouldn't put yourself at excessive risk by investing too early. He compares it to making a wager on a baseball club before the starting lineup has been released, and he's right. Enter early, but not too early, he advised. When it comes to growth equity investments, I frequently compare it to a baseball investment. The third inning is a good time to join the game because a corporation has already proven itself. You're taking an unnecessary risk by purchasing before the published lineup. When it comes to new fund offerings, NFOs, many investors make the mistake of jumping on the bandwagon, thinking this is an excellent chance. Investing in NFOs is like taking a leap of faith. They don't understand that. It is usually preferable to stick with a tried and true strategy rather than trying anything new or untested. Financial markets are not immune to speculation. Performance is determined by creating additional demand and/or by higher prices. The internet has catalyzed increased transparency and fairness, making stock performance and financial advice more viable for the average investor. They are the areas historically closed off to the most common market participants. Anyone can purchase stock as easily as groceries from any retail location, any time of the day or night, from any computer terminal with an internet connection or smartphone.